You know what's keeping most retirees awake at night? Taxes. Having spent decades working hard, saving responsibly, and ultimately achieving that all-important retirement age, the last thing anyone needs is to see a huge amount of their hard work disappear down the government's gullet. But here is the secret: certain savvy retirees have found that they can lawfully pay not a single penny in taxes on decent-sized retirement income. It simply sounds too good to be true, but through clever planning and shrewd decision-making, a retired couple could virtually cut their taxes down to nothing, even on an income of $120,000 or better per year. Let me be precise. I am not talking about crooked offshore accounts or iffy tax loopholes. I'm talking about totally legitimate maneuvers that work in today's tax law. The reality is the vast majority of people simply are unaware of how retirement taxation works, and thereby pay a significant amount more than they must. That ignorance takes money out of retirees' pockets to the tune of thousands, often tens of thousands of dollars each and every year. So settle in, grab your coffee, and come along with me as I stroll through the way some retired couples can pay no tax on enormous retirement earnings. If you are already retired or planning ahead, these insights can save you a small fortune in the duration of your retirement. Let's start with the basis for tax-free retirement income. The answer is in understanding the varying tax treatments of varying streams of income. Not all retirement income is taxed the same. Withdrawals from a traditional IRA and 401k are taxed as ordinary income, while Roth IRA and Roth 401k withdrawals are tax-free if you have met the qualified distribution criteria. Social Security benefits are taxable to some degree depending on your income level, and some investments can generate capital gains which have favorable tax treatment. The Tom and Linda of our example have structured their retirement income to maximize tax advantage through numerous streams. They did not end up in this position by chance. They planned to, in some instances decades in advance. Even if you are retired already, though, you can still restructure your finances to reduce tax impact. Tom and Linda derive income from numerous sources: Social Security, Roth distributions, qualified dividends, and strategized traditional IRA distributions within some tax brackets. They arrange the distributions meticulously so that they use the standard deduction to its fullest extent and keep their taxable income low enough not to be required to pay federal taxes. Social Security taxation is particularly intricate. Few retirees know that whether your benefits are taxable, and how much, depends on your combined income. That is your adjusted gross income, plus tax-free interest, plus half of your Social Security benefits. For couples filing jointly, if their combined income is less than $32,000, none of their Social Security is taxable. Between $32,000 and $44,000, up to 50% is taxable. More than $44,000, up to 85% can be taxed. Tom and Linda have been carefully planning their retirement income so that their combined income levels do not approach critical levels. They're not taking money out at random from accounts. They have a thoughtful plan that considers tax costs on each dollar. Another of their tactics is the strategic conversion of Roth. Years before retirement, they began to convert some of their old-fashioned IRAs to Roth IRAs. Yes, they did owe tax on those conversions, but they did so when their income was lower and when they were in a lower tax bracket. Their planning allows them to make withdrawals from their Roth accounts tax-free in retirement, which keeps them from owing many taxes in total. A part of their strategy also includes handling capital gains. Long-term capital gains on investments held for more than a year, are generously treated by the tax system. For 2024, joint filers who have a married spouse can accumulate up to $89,250 in long-term capital gains and qualified dividends and stay in the 0% tax bracket on those specific types of income as long as they do not earn any other income. Even with secondary sources of income, knowing how to handle investment distributions can significantly sway your tax profile. And then there are RMDs beginning at age 73. Aren't these obligating retirees to make taxable distributions whether they are needed or not? Yes, but Tom and Linda accounted for this as well. By converting their accounts to Roth positions strategically earlier in their retirement, or even pre-retirement, they reduce the funds in their traditional IRAs, which, in turn, reduce their future RMDs. They also donate some of their RMDs directly to charity in the form of qualified charitable distributions, QCDs, which aren't included as part of their taxable income. Medical costs are another big retirement planning consideration. Few retirees know that Medicare premiums are means-tested, the more you earn, the more you pay in Medicare premiums. By limiting their modified adjusted gross income, (MAGI), to certain levels, Tom and Linda are exempt from paying extra Medicare premiums, which costs them thousands per year. Another key but lesser understood aspect of tax-free retirement is state taxation. 7 states have no income tax: Alaska, Florida, Nevada, South Dakota, Texas, Washington, and Wyoming. 2 more, New Hampshire and Tennessee, don't tax wages but do tax investment income and dividends, although Tennessee is phasing this out. And then there are states such as Pennsylvania, Illinois, and Mississippi that don't tax withdrawals from 401(k)s and IRAs. Tom and Linda relocated to a tax haven state after retirement, eliminating state income tax entirely. Others also include real estate strategy into their planning as well. Rental income can be reduced by depreciation and other expenses and even end up being tax neutral or even tax negative income. Housing within some opportunity zones might have additional tax advantages. Other people utilize 1031 exchanges to defer forever taxes on investment property. Those strategies involve sophisticated planning and typically professional consultation, but they can be quite potent in producing tax-efficient retirement income. Business income is another avenue for tax-favored retirement income. Some retirees start small businesses or consulting firms, which allows them to claim legitimate business deductions that offset income. This is not a question of creating phony firms, it's a question of structuring real economic activity in effective tax forms. Let us return to our example couple. How exactly do Tom and Linda structure their $120,000 annual earnings to yield zero federal taxation? Here's a simplified example. They receive approximately $40,000 of Social Security income. As they keep their other sources of income in a tight grip, little of this is taxed. They withdraw approximately $30,000 of the funds from their Roth accounts, which all remains tax-free. They receive approximately $25,000 of qualified dividends and long-term capital gains, which are qualified as being in the 0% tax bracket due to the total amount they are receiving. The other $25,000 comes from ordinary IRA distributions, which otherwise would be taxable. But since the joint filing standard deduction for married couples is $29,200 for 2024 if both are 65 or older, this too is essentially tax-free. This careful balancing of streams of income generates no federal tax liability, even on a comfortable 6-figure income. It's no magic, it's intelligent planning on the basis of intimate familiarity with tax rules. Now, I need to emphasize that acquiring zero tax on $120,000 of retirement income is not an opportunity available to everyone. It will hinge on the composition of your retirement funds, your other income sources, your state of domicile, and sometimes your desire to relocate or restructure your finances. What works for one couple may not work for another, which is why individual professional advice is so crucial in this area. Furthermore, tax laws change over time. What is effective today may not be effective in 5 or 10 years. Because of this, ongoing tax planning during retirement is required, not an occasional activity. For those yet to retire, the message is, it matters not so much how you save for retirement as that you save. The tax status of retirement accounts and income sources in retirement is critical. Asset diversification across different types of accounts, traditional, Roth, taxable investments, real estate, etc., provides you with maximum flexibility to optimize your tax situation in retirement. For current retirees, it's not too late if you haven't been concerned with taxes. There are still plenty of things you can do to rearrange your retirement income and reduce your tax burden, saving thousands annually. Some of these might include opportunistic Roth conversions, relocating to a low-tax state, restructuring your investments to hold more tax-efficient investments, or strategically timing distributions from different accounts. It's worth noting that while minimizing taxes is important, it shouldn't be the only factor driving your retirement decisions. Quality of life, proximity to family, healthcare access, and personal preferences all matter too. Sometimes paying some tax is worth it if it means living where you want or having the lifestyle you desire. Key takeaway: tax planning for retirement must start many years ahead of when you retire, ideally decades in advance. But even if you are already retired, there are plenty of strategies for optimizing your tax situation. Another helpful insight: tax brackets work differently than most people understand. Altered tax brackets to a greater level doesn't have your entire income taxed at that level, just that which is above the cutoff point. It is imperative to proper retirement planning to value the progressive tax method. Social Security tax is one of the most difficult parts of planning for retirement to understand, yet one of the most significant for determining how much your overall cost of taxes is going to be. The laws have marginal rates of tax which in certain brackets are fairly extreme, so considerate planning is crucial. The timing of retirement income is important. Sometimes the tactic of receiving more income in one year and less in another can reduce your lifetime tax burden significantly, especially at milestone ages like 65, Medicare eligibility, 73, RMDs begin, and when Social Security is claimed. The investment choices you make within different kinds of accounts can also assist you in becoming more tax efficient. As a general rule, investments generating ordinary income should be held within tax-favored accounts, and those generating long-term capital gains or qualified dividends may be better held in taxable accounts, if your overall income puts you in favorable capital gains tax brackets. Healthcare costs and taxes increasingly become intertwined for retirees. More income not only increases your tax bill, but it also can increase your Medicare charges in the form of income-related monthly adjustment amounts, IRMAA. This creates tax cliffs where one extra dollar of income can result in thousands of dollars of increased healthcare expense. Charitable donations are another strong resource in the tax planning arsenal of the retiree. Qualified charitable distributions from a donor-advised fund, IRAs, or bunching plans can all serve to manage taxables while supporting causes that you believe in. In short, creating a tax-free or tax-low retirement takes careful planning in a number of areas: types of accounts, withdrawal plan, investment choices, timing, location, and in some cases, professional guidance. The strategies used by couples like Tom and Linda are not esoteric or covert. They can be had by anyone who will learn and plan. They do require foresight, self-discipline, and in some cases, some professional guidance to carry out effectively. Whether you're already retired or in the planning stages, having a sense of how the different components of the retirement tax puzzle fit together can save you tens or even hundreds of thousands of dollars during your retirement. And in retirement, every dollar you save on taxes is another dollar that can be spent on the lifestyle you've worked so hard to achieve. Don't forget, the goal isn't to pay zero taxes at all, it's to pay no more than you must, so that you can reap the rewards of your years of labor and saving. With proper planning, that burden could be considerably lower than you would have otherwise thought, even possibly zero.